our webinar, ESG Investing Explained, a Perspective from Dimensional. I'd like to go over a couple of upcoming events. We've got a pickleball social on September 12th from 5:30 to 7:30, an upcoming partner webinar series, Stirring Developments at the Unusual Intersection of Advisory and Annuity, brought to us from our platinum partner, Midland Advisory, on September 26th from 12 to 1. And a quarterly meeting, Navigating the Future of Fee-Only RIAs, on October 11th from 8 to 10 a.m. at the Bucket Club. Check our website for details and register today. We're joined today by Lacey Huebel, Dimensional's Head of Responsible Investment North America, as well as a Senior Portfolio Manager. Please submit your questions via the Q&A feature within the Zoom controls at the bottom of your screen. And with that, I'll turn it over to Lacey to begin.
Great. Thank you so much, Kathy. It's great to get to be here today to talk about ESG investing. Just a brief agenda. We'll start off with really where it all begins. What is this ESG stuff that we are talking about, that we're hearing a lot about right now? We'll dive into a bit of some of the complexities that we see around ESG data and measuring ESG objectives in dedicated ESG strategies. And then we'll take a look about how we think about sustainability considerations at Dimensional, really that specific subset of ESG investing. Now, before we even get started with the very basics of what is ESG. Now, it sounds very basic, but can actually be quite complex. I think it'd be a good opportunity to talk about this term itself, this term ESG, because it's something that has really become quite politicized, quite divisive in this country specifically. And so I think it's worth mentioning at the outset, what we're really talking about here, what's at the heart of this ESG considerations within investment strategies. And that really is just this ability, this flexibility for investors to align their investments with their values. ESG investing in the broadest sense, it doesn't belong to one specific set of values, one specific set of religious beliefs, one specific set of political ideology. ESG is for whatever the system of values that an individual investor may have, that ability to implement those values within their investment vehicles. Now, as I mentioned already, I'll be diving specifically into sustainability strategies, because some of those considerations get a bit more complex to think about implementation and how to think about those within an investment vehicle. But that's not the only thing that's covered by this term ESG. ESG really can be for anyone, no matter what their specific system of values are. It's a term that I certainly wish had not become so politicized, because it's something that really can be for anyone who wants to have their values incorporated within their investment vehicles. Of course, many investors don't. Many investors really want to focus on financial considerations within their investment vehicles. But for those investors who want to have their system of values reflected within their investment portfolios, that's really what we're talking about when we talk about ESG. Now, as I just mentioned, really, really broad term. So ESG, of course, as probably most of you are aware, the E stands for environmental, S for social, G for governance. When we think about environmental, what impact does a company have on the environment? Also, what impact does the environment have on a company? These are big questions, big topics. Just the E alone already is pretty massive. Then we get into the S for social. We're widening out our scope even further. What kind of relationship does a company have with its customers, with its employees, with the communities in which it operates? S is incredibly broad and in many cases can be quite subjective. And then we get to G for governance. Does a company have the right people in place with the right experience to do the best job possible of managing risks and pursuing opportunities for the company in the evolving landscape wherever that company may live? Also, an incredibly complex, incredibly large topic. So, with this term, this ESG term being so big and encompassing so much, it's probably not a surprise then that those organizations, standard setters, and also data providers that are trying to assess whether companies have good or bad ESG characteristics, whatever that may mean, there's a lot for them to think about. So, when we look here at some of the numbers, we have SASB with or Sustainability Accounting Standards Board, a well-regarded international organization, 26 ESG issuer categories. Similar number, the Sustainability Development Goals, SDGs from the UN, 17 goals with 232 indicators to feed into those 17 goals. Then we look out to ESG ratings providers, looking at Sustainalytics, MSCI, each of which has over 200 indicators going into this one number that they then assign to each company, ranking that company from an ESG perspective. So 200 pieces of information feeding into one single score for every company in the universe. So definitely a large, massive topic. Now, when we talk about then implementing ESG considerations within an investment portfolio, we can see how big the problem becomes quite quickly because this is such a big topic. So at the outset, it's certainly very tempting to use these kinds of ESG ratings to assess portfolios based on these kinds of scores that have all of these considerations going into account, that have 100, 200, 250 different indicators feeding into that score. Because these topics are all topics that different investors could certainly care about. A lot of us have, I mean, I could certainly just speak for myself here. I have opinions on a lot of different things. So why not have 200 different items that I could have an opinion on and feed into my assessment of a company from an ESG perspective? So let's dive into why that becomes so difficult. We'll do so by looking at examples across just a few companies here. And we're looking, I want to point out, at very large, well-known companies here. So we're not going to be cherry-picking data. We're going to be looking across several different industries and picking the biggest company within each of those industries. So we're talking about companies like Amazon, Microsoft, Nextera, Walmart. If we're going to be able to assess a company from an ESG perspective on any company, it's going to be these companies, right? There's a lot of publicly available information about these companies. These are very, very well-known companies. But even within these companies, even within these massive, very public companies, we see that when we look across different providers of ESG assessment, ESG ratings, we see incredibly disparate results in how those rating providers assess each of these companies. So just as an example, looking at the very bottom of the page, we've got Nextera. Is this company, from an ESG perspective, just absolute leader within its industry, top decile, really setting the standard for what it means to have strong positive ESG characteristics? Or is this company bottom third, really nowhere near where the rest of its industry is in terms of ESG considerations, ESG incorporation in their business practices? It depends on who you ask, right? We've got one provider saying this company is just stellar, top decile. We've got another data provider saying that this company is bottom third. Assessing companies across 200 or more indicators is going to lead to widely different results for different companies. And I'd like to dive into just some of the specifics about why that is. One thing that comes up certainly is that we're combining really different things, right? Environmental considerations, social considerations, governance considerations. Each of those are very different from one another. A company that frequently comes up when we're talking about ESG considerations is Tesla. So, from an environmental perspective, is Tesla going to be a company that has good characteristics or bad characteristics? It kind of depends on how you're looking at it. Certainly, if you're looking at emissions of the products that they create, electric cars, depending on the region in which they're driven, but generally have lower emissions than gas vehicles. So from that perspective, you might think Tesla looks pretty strong. Then Tesla's manufacturing practices tend to be less sustainable than other car manufacturers. So maybe from that perspective, maybe not as strong environmental perspective. So that's kind of mixed. But generally, people would think of Tesla as having strong environmental characteristics. Generally, Tesla's going to get ranked somewhat poorly relative to its industry peers from a social perspective due to various labor considerations. And then from a governance perspective, that one really is going to depend on who one asks and on which day. Certainly, there's been a lot in the news about Tesla's governance practices recently, executive compensation, things along those lines. So trying to combine environmental considerations, social considerations, governance considerations into one score is certainly challenging. But I will say that even if we look across, even if we divide it out, even if we look at environmental specifically, then social specifically, then governance, you still end up with quite a disparity of results in how different ratings providers assess different companies. And here you'll see we're still looking at pretty large, well-known public companies with a lot of information out there. And we're breaking out that ESG score where we see some differences across a couple of providers here, MSCI, Sustainalytics, FTSE. And we're breaking that out into, well, how do they assess these companies from environmental perspective, from a social perspective, from a governance perspective? And even within each of those categories, we still see some differences there in terms of how the companies are being assessed by the different providers. So even breaking out that ESG into E and S and G still leads us to see different results across different companies. All right, so let's look into that a little bit more. Here we've just put together an example because if we tried to show you a real example with 200 different indicators, it would not be very helpful in understanding all of the things that are at play. But really, the differences between how providers assess different companies on different ESG criteria really come down to three main topics, and that's going to be which indicators are included. Just because two providers include over 200 indicators doesn't mean they each have the same set of 200. How different indicators are weighted and how different indicators are assessed. So here, just in this example, we see a company getting different scores based on different providers' assessment of their criteria. First, I think the first thing that I notice is the different weightings. How much do you weight environmental? Do you weight social? Do you weight governance? Within environmental, how much do you weight, in this case, emissions versus toxic waste? So just how those things are weighted has a really material impact on the final assessment, even if you assess those items the same way. Then we get into things that are pretty subjective, like at the bottom, business ethics. We've got one provider assessing this example company as pretty strong, one saying pretty weak. And both could absolutely be making no errors in judgment based on available information and just reach different conclusions, which certainly happens with a lot of these more subjective metrics. And then finally, we have one provider including gender equity, one including health and safety, having different indicators in versus out. All of these types of differences lead to those really strong divergence in the final results. So trying to use these broad ESG categorizations, these broad ESG ratings, in order to really assess companies and make decisions about what an investor wants to include or wants to exclude within their investment portfolio is really going to lead to a lot of confusion. Because when we try to incorporate so many different considerations, we don't really understand the impact that any consideration is having on the final characteristics of the portfolio. So if there is a topic that investors find to be really important to them, something that they really want to see reflected within their investment strategies, it's incredibly difficult to assess whether it even is having a meaningful impact on the resulting weightings and inclusions and exclusions within the strategies when there's so much going in to that final score. So when we're thinking about ESG strategies, I think it's really important for investors to think about maintaining a strong focus, focusing in on those ESG characteristics that they care most about, that are most pertinent to them, and making sure to reflect that those topics are being reflected as best they can within their investment vehicle. And then assessing the investment vehicle's characteristics based on those particular sets of values that they've decided to incorporate within their investment strategies. So certainly finding that focus is something that's incredibly important for ESG investing. Another item that I think is incredibly important for ESG investing is that second word of ESG investing, making sure that we maintain a really solid approach to investments within an ESG strategy. Because investors certainly, when they're looking to have an impact, real world impact in line with their values, thinking about that as a part of their overall financial picture. We've got that here on the far right of this spectrum of how investors think about their financial situation, philanthropic contributions. So accepting a complete loss of return, of course, but in order to have a real world impact that is in line with whatever specific set of values that investors have. And then we think about a dimension about our social or sustainability strategies is really supporting those efforts, as well as investors' efforts in being able to meet their future spending needs, save money for future generations for those philanthropic contributions. So making sure that within those ESG strategies, while we are incorporating those specific ESG considerations in a really meaningful way, we're not losing sight of the fact that these are people's investments, and we're looking to maintain a similar risk-return profile, similar broad diversification that we would see in any investment vehicle. So a couple of different considerations that come up when thinking about how to evaluate an ESG portfolio, making sure that we're focusing in on those topics that are most important to investors from an ESG perspective, and making sure that we're not losing sight of the investment side of things, making sure that we still maintain a strong approach to investments within that strategy that's also integrating those additional specific ESG considerations that the investors want to see reflected within that investment vehicle.
Hey, Lacey.
Yeah.
We got a question from the audience that asked, what are your thoughts about all the negative media around ESG, with various articles pointing to the craze of ESG fading and disappointing returns? Now, there's a couple things baked into that, but maybe even here on when you're talking about the spectrum and how to focus on investing, and really how maybe even some of these articles I know that we've seen kind of take away from that.
Yeah, absolutely. Like you said, there's a lot baked into that, and part of it is kind of how I started out. That I find it to be just so incredibly unfortunate that this term has become such a political topic when it really doesn't need to be. If two different investors feel completely opposite ends about a particular topic, they both have the capability to invest in such a way that's in line with those completely different views on that topic. And that all can fall into this ESG lens of just whatever your values are, being able to incorporate those, see those reflected within your investment vehicle. Now, there's certainly a lot of attention about this being a fad. I don't think we see any significant evidence of that. There's been a pretty steady increase overall in investments into specific ESG strategies, either looking at from a sustainability perspective or faith-based investing perspective, whatever perspective we really use. In speaking with investors, I feel like part of it, and I certainly am not as much of an expert as anyone else in this room, so I apologize for speaking to something that you all know so much more about than I do. But I have found that younger generation has really embraced more control over their investments in some ways, and kind of this awareness that, oh, actually I can have that control, that power to incorporate these considerations within my investments, whatever they may be. We've seen pretty solid flows into ESG investing in the US year over year over the past 3 years, 5 years, 10 years. And it seems to be something that continues to have a steady interest. Now, part of that interest in ESG investing is going to be from people who are chasing returns. So people who think that they're almost betting on an even greater increase in ESG investing. So they're trying to kind of get ahead of the curve, invest in strategies to try to chase returns. Those types of investors are everywhere, not just in ESG. And it's something that tends to ebb and flow based on however the market is doing. But for those investors who have a really strong set of values they've incorporated throughout their lives in how they make decisions about their families, about who they spend time with, about what jobs they do. I mean, our systems of values guide everything that we do. And for those investors who feel strongly that those same sets of values should also be incorporated within their investment vehicles, those tend to be pretty sticky assets. Those investors aren't going anywhere. Their values aren't changing, and they continue to express interest in investing in this way. So I think it can vary, but yeah, sorry to go on so long, but it is such a good question. It really touches on so much, I think, of what makes this such a complicated topic, and really the importance of how we evaluate kind of the noise that we're hearing out there about ESG investing, and really think about what this is. This is something that is allowing investors to invest in line with beliefs they hold to be incredibly strongly, whether through their just personal set of values, whether it's through their religious affiliation, whatever the case may be. And it's something that we continue to see interest in from an individual investor perspective, absolutely. But again, still maintaining that focus on investments, whether or not you're interested in ESG considerations or an investor's interested in ESG considerations because they have this view on risk return profile, anything along those lines. I think it's really important to think about how the ESG considerations can be integrated in such a way that we can still maintain the focus on risk return profile, and diversification and targeting drivers of higher expected return, the same way we would do in any investment vehicle. So let's talk about, again, those two topics, finding your focus and integrating that with an approach to investments, and really how that influences how we would think at Dimensional about adding ESG screens to an ESG portfolio, a dedicated ESG strategy, looking to meet investors in terms of their personal sets of values. So first, again, on this list, identify the issue, or we could say it is find your focus. What are those topics that are most pertinent to you, that are bringing you to the table in terms of looking for a sustainability strategy or social strategy or SRI strategy or whatever the case may be? What are those topics that are most pertinent to you? Then, can we reasonably incorporate those considerations within an investment vehicle in a meaningful way? There are certainly many topics we'll find that investors really care about, would love to see reflected within their investment vehicles, but that we just don't have solid, somewhat objective, measurable data around that really I think is what is so critical in making sure that we're taking these issues seriously. Right? Investors are coming to these ESG strategies for reasons that are incredibly important to them and incredibly personal to them. So we want to make sure that if we're telling them that we're incorporating a specific issue within their investment strategies, that we're really doing our part to make sure that we feel confident in saying, yes, we're taking a look at this issue. If you don't want to invest in companies that are involved in tobacco, that are involved in alcohol, we can certainly look through to see a company's source of revenue, what percentage of their revenue is derived from production or revenue from sales of tobacco products or alcohol products or whatever the case may be. And we can incorporate an exclusion based on those considerations within an investment vehicle and do so in a way that's really meaningful. So making sure investors have found their focus for ESG considerations, that we can incorporate those considerations in a meaningful way. The data's out there, good coverage, fairly objective, fairly measurable. And then we can incorporate those considerations in a way that really balances the trade-offs between being able to manage a solid approach to investments within that vehicle. If a particular consideration that an investor would want to incorporate in their strategy is going to exclude 95% of the universe, then we're not going to be left with a strategy that we're able to manage in a way that's consistent with that investor's risk return profile, which is, of course, going to be an incredibly important aspect of any investment vehicle, but an ESG strategy as well. So we want to make sure that we've not only found those topics and we've found the data, but that we can incorporate them within a strategy in a way that still allows us the flexibility to maintain a broadly diversified investment vehicle that can pursue the drivers of higher expected return. Now, we can't tell investors what their values are, of course. We need investors to do that for us. We need advisors to do that for us. So we work really hard on maintaining really open channels of communication, having conversations with advisors who are speaking with these investors on a day-to-day basis. And that allows us to understand those topics that are most important to investors, they're hearing the most about, that they most want to see reflected in their strategies. So now I'll start focusing in on our sustainability strategies. When investors come to us looking for environmental sustainability strategies, the primary topic that we're hearing about from them that they most want to see reflected within their investment vehicles is around climate change. And so from our perspective, in order to best implement those strategies, we focus on reducing exposure to fossil fuels and reducing exposure to greenhouse gas emissions. We're going to take into account other environmental considerations as well. We'll dive into some of that, but really finding that focus on those environmental considerations is going to help make sure that the strategies are in line with those topics that are most pertinent to investors, that they're most looking to see reflected within their investment vehicles. Now, again, we're going to make sure that we're doing everything in such a way that we're still able to provide well-diversified strategies, targeting higher expected returns, keeping transaction costs low. Now, just diving a bit into those sustainability considerations that we utilize at Dimensional within our sustainability strategies here, sustainability and social considerations, again, focusing on climate change. So the focus of how the strategies incorporate these considerations is going to be reducing exposure to companies with highest carbon emissions intensity, the highest potential emissions from reserves, which is just a fancy way of saying coal, oil, and gas that companies have in their assets, and making sure that we focus in on those companies instead that have more sustainable business practices in line with investor-specific set of values around environmental sustainability for these strategies. Now, in addition, as I said before, always keeping those conversations going about what investors are looking for within their investment vehicles helps us to screen out other topics as well that we're hearing from investors that they want to see reflected within these strategies. Some of the recent additions to exclusions within the sustainability strategies include palm oil, something that we weren't hearing too much about maybe 10 years ago, but certainly something that became of significant importance to a lot of investors within the past 5 or so years, and something that we were able to add as a screen to our investment vehicles. Private prisons is another topic that came up recently. We recently incorporated an exclusion for that into our sustainability strategies. So these topics are evolving over time as more and more topics come to light in some ways, and as data quality improves. Environmental sustainability is an area that's you could say it's been going on since the 50s or 60s probably, but really the explosion in how much specific information, measurable information that we have on these topics is very, very recent, especially if you think about how long of a track record of data that we can get from different investment considerations like market capitalization or value characteristics, anything like that. We can pretty easily get data going back to the 1920s. Then we get into environmental sustainability, and you're pretty lucky if you can go back to the 2000s and the early 2000s, and anything before that is going to get really challenging. So definitely important to stay on top of these topics, both from the perspective of what investors care about and also from the perspective of the evolution that we're seeing in data quality. So how does it look to have really these two pillars within these sustainability strategies, right? On the one hand, making sure that we're emphasizing those investments that have that are really focused on drivers of higher expected return, and also emphasizing those companies that have more sustainable business practices, and also implementing additional exclusions based on specific topics that investors really care about. So we can sort the universe based on any of these topics and apply multiple sorts based on the investment characteristics and based on the ESG characteristics that are the focus of the strategies. So going left to right here, sorting the universe in this graph based on relative price characteristics, size characteristics, profitability characteristics, emphasizing those companies that have stronger expected returns going forward, de-emphasizing those companies with weaker. Also sorting the company based on emissions intensity, emphasizing those companies with lower emissions intensity, de-emphasizing or excluding those with higher emissions intensity, doing the same for fossil fuels from reserves, applying additional focus considerations. All of these can happen within the investment universe at the same time and really allow us to provide an investment vehicle that in the end focuses on those companies with more sustainable business practices, still targets drivers of higher expected returns, still maintains that broad diversification. And I know I've spent a bit of time on this topic of integrating these two together, but I think it's incredibly important to focus on that with ESG characteristics because it's something that can at times be a bit lacking within this space. We can see people making this trade-off of emphasizing certain ESG characteristics in such a way that the universe ends up shrinking really significantly to the point where it can impact the risk-return profile of the vehicle. So just taking a look here at some of the numbers for the dimensional sustainability strategies, as well as some of the larger sustainability and ESG ETFs out there, and focusing in on these numbers that we're focusing on within our investment vehicles, our sustainability strategies, because we hear about these topics a lot from investors and what they're looking for out of their ESG or sustainability strategies. But you can see dimensional sustainability strategies still maintaining a significant reduction in weighted average carbon intensity, a significant reduction in potential emissions from reserves, those emissions that would be produced from fossil fuels, from coal, from gas, and that companies have in their assets. So a significant reduction in those environmental characteristics, improvement in those environmental characteristics relative to the benchmark, as well as relative to some of the larger peers in this space, breaking out into US, international, emerging. Now, while we still bring this really big, meaningful impact on environmental characteristics, we're able to do so in such a way that we're not having to sacrifice so significantly on the investment universe. And you can see that over there on the right, where some of these strategies are narrowing down that investment universe to a few hundred names, whereas our sustainability strategies are really able to keep that broad market exposure. Diversification, of course, the one free lunch that we get in investments, it helps us reduce risk. It also helps us pursue higher expected returns in a more reliable way. We don't want to give that up. We're not going to give that up. And we don't have to give that up while still integrating within the strategies an incorporation of those ESG considerations in a way that's meaningful and impactful that investors can really see.
Lacey, we got another question on how we construct strategies. They said, do any of our topics include how much offshoring or outsourcing to foreign countries a company might do?
So it depends. So the strategies look at what's called Scope 1 and Scope 2 emissions. So we're looking at Scope 1 emissions are, smoke spewing from the stacks, so what companies are actually burning themselves. Scope 2 emissions are going to be what it takes to keep the lights on, so energy that companies are purchasing and then consuming themselves for their own offices, for their data centers, for whatever the case may be. Scope 3 emissions get into things that are a bit more downstream, also start including things like travel, commuting to work, things like that. So our investment vehicles are really focusing on Scope 1 and Scope 2 emissions, just because of that reliability of data, less estimations going into those numbers than we see with something like Scope 3 emissions. I could give so many examples of funny things that happen with Scope 3 emissions. I think a couple of my favorites are, if a company produces a light bulb that lasts for 50 years, and then another company produces a light bulb that lasts for a week. The company with a light bulb that lasts 50 years is going to have higher Scope 3 emissions because the emissions of that, the company is basically getting dinged for emissions for that light bulb over 50 years, whereas the other company is just getting dinged for a week of their light bulb working. So there's things that end up being a bit counterintuitive when you start really diving into Scope 3 emissions. Also, when I talk about emissions, Scope 3 emissions and estimations, there's I don't want to name names, but a company, every car company manufactures electric cars now. So one of the companies that manufactures electric cars, when they were assessing the average emissions of their cars, because Scope 3 emissions, again, go pretty far downstream to the emissions that your products produce, they were estimating the emissions of their vehicles that are driven in China. And they used, for all the vehicles driven in China, they used a grid in China that's nearly completely renewable energy. So the cars looked great. However, some of those cars are driven in other regions in China that are on different grids that are primarily actually relying on coal. So it's just those kinds of estimations that can make comparing Scope 3 emissions across companies incredibly challenging. So some of those topics that get into more downstream efforts, what companies are kind of outsourcing, what they're involved in further down the supply chain, are going to go into that Scope 3 bucket. And at this time, it's not something we're looking to incorporate within our strategies. I think in the future, I personally think in the future, we'll see that data improve data quality, as well as more standards around how various things are estimated. At that time, it could be something that we look to incorporate within our strategies. Right now, we're really focused on those more objective and measures that are that we find in scope 1 and scope 2 emissions. That doesn't mean that they are completely objective without any estimation at all. I definitely don't mean to imply that. It's just something that we see a bit more consistency around than we see in something like scope 3 emissions. But as far as specific activities, now I don't know if that was being driven on, asked about in that question as well, where you see something like, offshore drilling or something that could have a material impact on a specific segment of the environment, but may not be found anywhere else, like in the scope 1, scope 2 emissions. Those topics we do try to address within our business conduct screen that we have within our sustainability and social strategies, that's looking at companies that are flagged for violations of OECD guidelines, SDGs, various other international standards, and then assessing those companies and those controversies, what they're flagged for, what kind of impact those controversies could have, how the company is looking to remediate, address those. A lot of things like that go into that screen. So it's certainly something that we look to take into account, but also something that is inherently quite subjective and difficult to assess. And we want to make sure that if we're saying that we're incorporating something, that we feel confident that we're doing so in a way that is honest and has integrity. All right, and just getting back to the investment side of things, something that is quite convenient is that we've been managing sustainability strategies for over 15 years now. So we have a really solid track record at this point from a sustainability perspective, again, where we have a bit of a lower bar of trying to look back on things. But 15 years is still a pretty reasonable amount of time where we can look at the performance of a strategy, of two different strategies that have similar investment objectives, or essentially the same investment objectives. Just one strategy has sustainability considerations and one strategy does not. And that's what we're looking at here with the Dimensional's U.S. Sustainability Core 1, U.S., and as well as the U.S. Core 1. So essentially same investment vehicle, one with sustainability considerations, one without. Growth of $1 over the past 15 years. And we can see these strategies really performing in line with one another over the lengthy time periods, over the longer time periods. Now, certainly can't say past performance indicates future performance. I definitely don't want to indicate anything of the sort. But what I will say is this is something that is expected and it's by design. Our sustainability strategies, as I said, are designed in such a way to incorporate sustainability strategies in a meaningful way, have a positive impact on ESG characteristics, but not lose sight of investments, still pursue drivers of higher expected returns, still maintain broad diversification. And historically, we've seen similar performance between sustainability and non-sustainability strategies, and that's exactly what we would expect. Now, we can see short-term differences in returns over shorter time periods, mainly driven by differences in sector performance. But over the long haul, we tend to see these strategies perform really similarly to one another. And those sector differences go back, I think, to first question about chasing returns, negative return of ESG strategies compared to non-ESG strategies. When looking over shorter time periods, a lot can go into play in impacting relative performance. And those investors who are looking into ESG investing to really chase those kinds of short-term returns are going to come in and out of these strategies based on those kinds of 6-month, 1-year, even 2-year performance numbers. But for longer-term investors who are really looking for that values alignment, I think these kinds of this kind of information is really valuable to help them figure out the place that ESG strategies can have in their overall investment vehicles. And at Dimensional, we do have sustainability strategies across equity and fixed income, mutual funds, and ETFs. I think what's important here is that within each of these strategies, we're looking at the sustainability considerations, the social considerations in a really consistent and similar way. And therefore, we're producing sustainability reports on each of these strategies in a way that's really consistent. I think this is incredibly valuable for investors who again, for whom these topics are incredibly important, to be able to have these reports that really help them to understand the impact that the sustainability considerations are having on the ESG characteristics of their portfolios, and being able to build out a portfolio comprised of various asset classes, various markets, all approaching sustainability social considerations in a similar way, with a similar focus on investments, really allows investors to see the impact that the sustainability considerations have across their investment vehicle in a way that's really consistent. I think this is something that we've seen a bit of a challenge in the regulatory environment, where there's this desire to have ESG reporting be consistent across all ESG strategies. But really, we need to evaluate ESG reporting based on the ESG goals, ESG targets of each individual fund. So having funds that are approaching these topics in a similar way is going to allow for that comparability in a way that that might be lost when combining strategies with different focuses. Now, there's certainly a reason for investors. There's certainly reasons that certain investors might want to focus on different topics within different asset classes. But for those investors who have this specific set of considerations that they want to see implemented, being able to do so consistently across asset classes, I think, is something that's really important. Now, if we brought 1,000 people in a room, we would have 1,000 different sets of values, of priorities, of preferences within those values. Within our commingled strategies, we do the best we can through our engagement with advisors, through your engagement with end investors, to make sure that we're incorporating those considerations that most investors can find to be important to them within their investment vehicles. We also have a separately managed account platform. And one of the things that it can help investors with, really help advisors with, is those more tailor-made strategies that really take into account a specific investor's specific set of values, priorities, preferences, and incorporating those within strategies. Of course, there's a lot of other things that can be done within separately managed accounts within the SMA platform. But certainly something to keep in mind in this area of ESG investing, where people can have such different approaches to what they want to see implemented within their own specific strategies. Customization has become really important for a lot of individuals in this space. Now, we've talked a lot about how we think about sustainability within investments. I don't need to spend too much time on our own operational sustainability efforts at Dimensional, but I did want to mention at least how some of these topics have really informed how we think about sustainability within our investment vehicles as well. Of course, for our own operational sustainability efforts, we look to measure our emissions, reduce our emissions, and then offset those emissions that we don't reduce as a firm at Dimensional. And I think we've learned so much along this process about various types of markets within the environmental space. So we've really really been in the weeds about carbon offsets and the varying quality of carbon offsets that we see out there in the marketplace, which is part of the reason that we don't give companies credit for their own carbon offsets that they market as helping to reduce their own emissions profiles. We don't give anybody credit because we're not going to do the work of assessing whether or not those offsets are of any reasonable quality at all. We're just not going to count them. So companies are only going to be assessed based on those emissions they're actually producing. We're not going to start looking into their marketing materials. In measuring our emissions, again, that helps inform our decisions about those different estimations and what estimations we expect to see companies use when they're putting together their own emissions profiles. So lots of things that we're able to gather throughout our own operational sustainability efforts that play a role in how we think about portfolio companies' own sustainability efforts. So certainly something that I find to be quite interesting, but especially here in our conversation today in how it informs how we think about sustainability investing. So I think, really overall, within sustainability strategies, especially, it's important to think about that approach to investments, assessing sustainability ESG strategies on making sure they still maintain a solid approach to investments, still maintain that space that they can hold within an investor's overall investment vehicle, and make sure that they have really specific, focused set of sustainability ESG objectives to really help align with investors' values, but focus in on those values that investors most want to see incorporated within their strategies, and then that they're producing really clear, transparent reporting so that investors are then able to assess how those investment vehicles are doing on implementing those characteristics. And then, of course, combining with that overall approach to investments is really what's going to be at the heart of what sustainability or ESG investing is all about, and what really gives investors that solid investment experience within this space. I'm certainly happy we're able to get to a couple of questions while we were going along. If there's any other questions that have come in, happy to address as well, or give folks a few minutes back. All right. Then, yeah,
there
Kathy,
was,
if you want.
oh yeah,
Yeah.
Sorry.
Go ahead, Jewel. Looks like we
Yeah.
had another question come in.
We had one more question, Lacey. It says, sorry if you've already answered this, but how do you navigate the evolving regulatory landscape concerning ESG investing? Are there any recent regulatory changes that have impacted dimensional strategies, ESG specifically?
So, yeah, the evolving regulatory landscape, absolutely. I think one thing that I found interesting was it's probably 6 months ago when we hit what I found to be a pretty wild milestone, where every state in this country now has either pro or anti ESG legislation in its books. So that's exciting. I don't know if anyone else had a toast to that. So absolutely an evolving landscape. And then at a national level in the US, a landscape that we expect it could go back and forth. We've seen various guiding languages in the US that has switched back and forth based on which party is in presidential office. And then certainly we've seen regulatory evolution in Europe, in UK, and Australia, but certainly I'll focus a bit more on the US. Probably the main pieces of legislation that are going to not necessarily necessitate some changes in strategies, but potentially some changes in how things are being reported or classified or what language we can use, are going to be the clarification of the names rule. The names rule has always required that 80% of the investments of the strategies are in line with the name of the strategies. This clarification is just saying, hey, we mean ESG too. If you've got ESG in the name, you've got to have 80% of the investments in line with that. And that's something that we've always abided by. So that's not going to have an impact on our investment approach, but will have an impact potentially on different language. We're starting to see different regulatory bodies define terms like sustainable, sustainability, environmental, ESG. So making sure that all of our material is really in line with those evolving definitions. How do we do it? With a team of lawyers and paying a lot of attention to what's going on in the US and various states and the world. We've seen some disclosure requirements come out of certain regions that could necessitate certain additional reporting on some of our, not so much on our strategies, but on our own operational efforts. So I think there's a few things that are in the works from a regulatory perspective that could certainly lead to some changes in some of the language that we see out there, more so than in the actual investments themselves. Whereas in Europe, we're seeing regulations that really impact investments and really, promote those strategies that hold, 50 names in a very concentrated manner with specific ESG objectives. and kind of, yeah, we're not going to count these well-diversified strategies as being sustainability strategies. So I think certainly interesting to see where that all falls out in Europe. But within the US, a few minor regulations that could impact language and things like that.
All right, thanks so much, Lacey. Thank you for this very informative presentation. And thanks everyone who connected with us today. Look for an event survey and the webinar replay to follow. Thanks so much, guys and gals. Good afternoon.